Hi guys, Harry Otis here, professional trader for 20 years now. Started my career in 2005, still alive in 2026. Okay, so today, Thursday, 30th of July, 2026, the penultimate day of July in what is a very devastating month for tech and for semis. Okay, and the big news of the day is it's the post-Fed recovery. Okay, yesterday we were talking about the Fed. The real move of the Fed is not going to be witnessed on the day, but 1 to 3 days later. Okay, so usually by the beginning of next week, we should know what the real move is because they try to trap traders on that day. Okay, so we're going to talk about that, the post-Fed recovery and what that means. Because today, as you recall, we were expecting a gap down open and we didn't get it. That's very, very positive for a number of reasons. Okay, but before we get into all these post-Fed recovery talk, let's talk about the technical picture. Still neutral, still in this chop zone. Yesterday we were worried that again gap down open and we would break this channel, but nope. Today still stuck in the middle. For all it's worth, the market is in a consolidation pattern after a big rally forward. This is generally bullish. Okay, however, it didn't look like that during this whole down move for the past month. Okay, but still, technical picture is neutral at this point. We will reserve our bullishness until we break to new highs. Okay, so what does the sentiment tell us? Fear still, plenty of fuel to go higher. Everything is in fear, extreme fear. Okay, we're still at fearful at highs, which is great for the bullish thesis going forward. Okay, and on Thursday, we always get the AAPL investor sentiment survey, which I like, and still a lot of bears, 42% bearish. I'm telling you, we're not there yet. We are not bullish at all at highs. 2 weeks of bears. Okay, that's not good. I mean, it's not good for the bears. Okay, because you're already at sort of extreme sentiment at highs. I mean, you don't have much room to go to the downside. Okay, this is classically a wall of worry. This is what you have up here at the highs. Everybody think it's going to go down. Everybody thinking it's the next 2008 or the next 2000. The semis are getting destroyed. It's going to, the bubble's deflating. It's 2000, tech bubble bursting all over again. No, man. Every situation is different, okay? Back then we were at euphoria at the highs. There's no euphoria at these highs. Okay, so the sentiment is backing up our bullish thesis. Okay, we did have some good macro numbers today. The first minefield of this week was the Fed. That came out dovish. The second minefield is tech earnings. Okay, that came out mixed yesterday. And the last one is, I guess, the war. the war, and maybe we can add another one, the semis, which is basically the market, how the semis are doing. Okay, those 3 or 4 factors, if you will, are what driving this market. And we're checking off one box. The Fed was fairly dovish yesterday, and today proved it. Okay, so let's get to the macro because we had some good macro prints. Okay, PCE, what the Fed actually looks at, negative, just like all the other inflation numbers. It came in negative for the month. Okay, and what did that's the PCE. Okay, the U.S. PCE, personal consumption expenditures. Okay, expenditures, can't speak. Okay, let's look at the core though. It takes out energy. The core PCE index month over month, 0.1%, basically nothing. Okay, even without energy, we're down. Okay, this way inflation is going down even without the war, even with the war. And you take out the war, imagine what it would be. Okay, inflation is on a negative downward trend, in my opinion, and that's going to help with our bullish thesis and the Fed. Okay, this is why Warsh is dovish. He said yesterday that the market is tightening enough for him. Okay, long bonds are already mid to long-term bonds are already tightening for him. He doesn't have to tighten. It's very, very dovish. Okay, so this is good for the bull case. We also had on Thursday initial jobless claims. 197,000 muted, so nothing. So as you can see, the macro is in our favor, okay, and the market is exhibiting that, okay. So let's get to the main event. Post-Fed recovery, we said we were expecting a gap down open. In fact, I'm disappointed a little bit. I wanted to have the gap down open so I can enter more trades, okay, because right now We only have like one quote unquote short-term trade, and that's on BE. Okay. And it's gonna, the put, we have a 135 put, it's probably gonna expire worthless tomorrow. We're looking for more trades. Okay, we'll get to that later. Okay, so the post-Fed recovery is very surprising. It just shows you that the sell-off that happened in the last half of post-Fed was BS. It was a trap, in my opinion. Okay, because the real move happens afterwards. Okay, people digested the news. They saw that it was very dovish. We saw the Fed Watch tool, and the key was one of the keys, small keys, the Fed Watch tool. We saw that in September, the odds now have increased to 63% for a hike. Okay, it's not 100%, but or 67%, which the Rubicon, anything above that, the Fed usually does it. But you see, it's the market is already pricing in one hike, and maybe two. Okay, we had no hikes at 10%. Now it's 15. It was close to 20 before. So today they got a little bit tighter. Things got a little bit tighter, but no effect on the market. Okay, because the market can take one or two hikes and done. Okay, and that was one of the keys of yesterday. You should have seen that it was very, very dovish, reflective in the Fed Watch. And the big key of yesterday, as I mentioned it on my Twitter, is the dollar. Look at it. Yes, tanking even today. Okay, back within this consolidation zone. It didn't break out. This is a false breakout now. Okay, now the 2 days of massive dovishness, because the dollar yesterday, forget today's candle, which is impressive. Okay, look at yesterday's candle. Here it was 0.6% drop. Okay, this candle never went down, never went up, meaning that it never got stronger. Okay, as if you look at SPY intraday, we're going to go to the 15-minute chart here. Okay, you're going to see this was yesterday. Okay, we're looking at this area here. As the Fed was speaking, boom, it was the market tanked in the beginning because they thought there's going to be a hawkish Fed, and then when the Fed's pre-Fed it started going up, and then when the Fed started speaking, boom, went even higher to the new highs. And then after, when Trump started talking tough on the war, it tanked. Okay, so this up down, you would have seen it if it was real. You would have seen it in the dollar. Like as this down move was happening after the Trump hawkishness and the war, you should have seen the dollar spike. Okay, and what happened to Dixie? Nothing. Down and stayed down. Excuse me. Here, this was yesterday, right? Wednesday here. Down and stayed down for the whole day. Okay, this is the whole day of Wednesday. Down and stayed down. Okay, and this is at night because the dollar trades 24/7. So, and then today, boom, 9:30, boom, and nothing. Okay, so the dollar, as the SPY was getting tanked, didn't rip. Okay, so let's go to the daily. Okay, you can see that it never ripped. So this was telling you, the international dollar was telling you that the hawkishness of the Fed flipped to dovishness. Okay, and the dollar reacted, and it reacted again today. So this is real. Okay, back within the chop zone. It's going to take a lot to bring it back up. Okay, something really, really bad has to happen for it to bring it back up. And I think it's because the inflation expectations that we saw are very low, and they continue to go low, and that's what the market thinks. And it's reflected from the dollar trading. Okay, the dollar trading this week is saying that the Fed is not going to hike as much as we thought. Okay, maybe one, that's not enough to really break it out of this downward trend. Okay, and that's a significant development. Okay, so we are not out of the woods yet. Okay, we have to have more. We have to go. Remember, we talked yesterday about the QQQs. Okay, we were hoping like it would gap down and maybe touch this. No, it might not. It's still in a negative move, negative downtrend. Okay, this upward move will only get negated if we get back up above this. Let's draw it here so you guys see it. Above this breakout point. Okay, if we get above that, it's looking better, and to new highs, it would be even better. Okay, but we look at the SMH first because we're looking for the semis to sort of bottom out, some kind of bottoming process, go sideways, maybe consolidate within this two bands of 568 to 522. Okay, because this didn't break out. The breakout didn't follow through. This could have been a trap because it covered the gap here. Covered the gap of 522 and then boom, back into it. Okay, it's still not done yet because it could still roll over. Okay, any kind of consolidation move around this area and bringing back up in August would be great. Okay, that's what we're looking for. Okay, and of course gold showing some strength consolidating at the bottom, recovering again today. Gold also yesterday didn't go all the way down with the market. If you see this candle here, this not this one, but not today's, but yesterday's. Yes, it was high, recover. It went back down, but it didn't go as far down as the market. The market was making new lows. Okay, and gold was holding this consolidation zone. So that's very, very positive. Okay, so that's what I wanted to say about this post-Fed recovery. We will know the results tomorrow, which is the last day of the month, which we should see some window dressing. There might be some bid there. Okay, but that's just one factor. We have to look at other factors as well. Okay, so the key to all this was the dollar and the Fed watch tool, which is linked. Okay, not as many hikes. Dovish Fed, that's great. Okay, so today we also have some other minefields. We had tech earnings yesterday, which was mixed. We had Meta, okay, down on the news, and we had Microsoft up big, 15-16%. Okay, on beating it. Okay, so you had mixed emotions, mixed tech earnings. Okay, and this is very good for Microsoft. It could follow through, look very, very good. Okay, you don't want it to reverse. Okay, so today we had what do we have? Amazon here. Let's refresh this. Okay, we have Amazon here. Earnings per share 5.7. Let's blow it up. Earnings 5.75. They expected 2. Amazing. Net sales 200 billion versus 197. Beat on both counts. So what is Amazon doing? I'm guessing it up. That's what you want to see. If it was down, then we have a problem. So up big. It's trading at 255 from 235. Okay, that's what 20 bucks, almost 10%. That's pretty good for Amazon. Okay, that's very good. Close up to near highs. So now we're just waiting on the last one, which is Apple. And Apple up a little bit pre-market. Did it announce? No. Financial Juice has nothing on Apple. No. Coinbase. But no, nothing on Apple. Okay. So we just have to wait more. Probably it's going to be, I'm recording this at 4:28. It's probably going to become a 4:35. Who knows? Okay. So we have to wait on Apple for tomorrow. So we have to understand how this tech, the other minefield is the tech earnings, how Apple will play out tomorrow. Is it going to be mixed like with Meta and Microsoft yesterday, or will this beat as well and go to new highs? We shall see. Okay, so far the tech earnings are good. And of course, we mentioned Bloom Energy is our only stock that we have left. We shorted this put. It's going to expire worthless tomorrow. So we're going to be looking for other trades to do tomorrow on a shorter term basis. Okay, we still have some of our longer term trades in gold. Remember, we also did the other type trades. We did it in Sprouts Farmers Market, which also had earnings today. Still stuck in a zone. We have a longer term zebra structure on it. I expect it to hit the 100, this level 100, after which we'll take some profits. And which other one did we have? If I recall. Oh yeah, we had Nike. Okay, Nike, same thing, still stuck in this zone. We don't know yet. Okay, our break-even point is like 42.50. We're at 42.29. We're at break-even. So we don't know. The key that I'm looking for is, as this recovery happens, I'm looking for the breadth here to get out from extreme fear and into, I don't know, neutral. That would be great. That would mean that this recovery, if it goes higher, would encompass all the stocks, other stocks as well, not just the tech sector. And man, this is like, the SPY is holding up very, very well despite the SMH semiconductor sell-off and the Kospi, of course, which is like, that's still down. See how it's much better? Our semi sector is much better than the Kospi. Don't look at that as a reference. Always look at our guys, and that's performing much, much better. Okay, still not out of the woods. Okay, it has to go above, let's say 600, 592, 600 before this down move can be, we can say that it's going to continue. Okay, because it has to break this head and shoulders pattern. As it stands right now, we're not out of the woods yet. Okay, so that's what we have to wait for. And for the month of August, so we're in neutral territory. Okay, I don't expect something big to happen. If it does, great. If it doesn't, play it non-directionally. We'll get to that as the month progresses, but so far that's it. That's it, guys. Let's see what the last day of the month brings, and I expect window dressing. Later.